I'll kick us all off. So thanks very much for everybody for attending this morning. I think almost everybody's on mute at the moment, which is great, just so that as there's no background noise while Ismail does some introductory talk. So just to set the scene, the way we're going to work this is Ismail will introduce his paper briefly, sort of summarize it over 10 to 15 minutes, and he's got a slide to help him with that. And then essentially we'll open the floor for questions and answers. And we haven't got a particularly structured plan around that. We'll see how the questions come. I know Ismail's got some interest in sort of probing a bit with people about some ideas, so there may be that he's got some questions for attendees. So hold your questions till we get to that section. We at Swoboda were really excited when Ismail offered to write something for us. We were keen to bring some voices from with a range of experience that comes from outside the credit union sector. There's a lot of research done by people like Paul and myself who are on the inside of the movement, and that's great because it gives us insights and experience and knowledge about the sector that we can use when we're researching new things. But it also means that our perspectives are probably framed by the sector. And it's harder to think more broadly and certainly to gather the kind of expertise that someone like Ismail brings from his banking background. So we were very excited that he wanted to write this paper, and we were delighted with what he produced for us. So, and let me just briefly introduce Ismail before I hand over to him. Ismail is at the Alliance Manchester Business School, which is where I met him because I did some work there. And he's been there for many years after working in a merchant bank and at Hull University, New York University. So he's an very experienced academic, but also has a background in practice. He's taught corporate finance, financial management in banking, international finance on MBA and executive management programs. So at a kind of postgraduate and to people who are practitioners, not just undergraduates. And he's very interested in financialization and financial innovation. And the reason I first got into discussion with Ismail was because he was looking after social responsibility. He was leading on social responsibility at the Alliance Manchester Business School, and has an interest in social finance, or the social utility of finance, and was keen to talk to me when he found out I was involved in credit unions. So he's got a personal interest in all of this, which we really value. So I'll hand over to Ismail, and then after Ismail's presented to us, we'll have an open discussion.
Well, thank you, Nick, for the introduction, and then thank you for having me. Good morning to everyone. As Nick referred to my background, I'm a specialist in credit unions, but I have a interest in social finance, and my research has been about the financial system, the role of various financial institutions within it. So it's an outsider's view of your sector and how it is likely to affect your business. But also there are new things happening, which is new not just to the credit union movement, but even to the banks, like fintech and this increasing interest on a green finance. So in that sense, a large chunk of the financial system is experiencing new challenges. So that's really the context. So what I will do is I'll basically go straight to my sort of a summary table in the report, and will explain what I mean by a threat, impact, and then what kind of recommendations I have in mind. But it will be good to discuss with you, because this is also for me and then for Nick and Paul as well, how we can get a conversation going about the recommendations. Do they make sense? What can be done? The realism, and so on, especially on the digital finance and net zero finance element. I mean, recently I was reading how, like electrical cars, of course, these things have lots of complex issues around them. Electrical cars are now being used as an example of moving towards more environmentally friendly mobility, but then there are also obviously issues about what kind of environmental damage happens when they're produced. But whatever it is, the electrical car is reducing carbon emissions in the cities. And then one of the things they realize is low-income people, they don't have driveways. So you cannot really charge if you want to buy an electrical car, if you're low income, and if you don't have a driveway, if you park your car on the street, then you cannot benefit from that. I think these things tend to sort of miss the policymakers' view. I think that's where community banking can be useful. I'm just imagining at this stage whether you can create sort of stations on the street to recreational purpose. Anyway, that's something that I came across recently. But basically, when we look at finance, because ultimately any financial institution, collecting deposits, having deposits, and converting them into loans, it is about net interest income. And we know banks have increased fee income, and in many cases, by not being very honest with their clients, as we know from mis-selling. But the higher the percentage of your income is from net credit, the low interest rate environment tends to hurt your business. And it has been a historically low level since the 2008 crisis, low interest rates. And any business with financial intermediation and net interest income reliance is likely to hurt. I mean, I haven't done a full empirical work on how it influences the sector, but having looked at some of the research and talked to them, I think there's also the issue of not being able to make loans. So, especially after the COVID crisis, people tend to keep more deposits. So there is an issue of increasing the net interest income. So, and I have, read and been to discussions how the capital formation is suffering as a result as well, at least in some credit union. So I'll come to my recommendations on that one. It's basically how to expand interest income generating business and products. And the second sort of external threat is, I know Basel is not fully applied, but there's a logic of Basel that influences regulation, and in some countries more than others, which is about keeping capital in relation to the risk on your asset side. So I'm more interested in the logic of it. And Basel inspired approach to risk management in banking, especially the credit loss and then liquidity, have not been beneficial even to the banking sector. It has some problems in the way they understand risk, and also, most importantly, one size fits all approach. Like even in the US, they realize that if you're keeping capital against liquid assets, then after COVID, it creates problems for many US banks, even because you don't meet the capital adequacy for keeping capital for things that are not risky liquid at the central bank. So I think that's something that the credit union movement needs to be aware of, the impact and how it might influence behavior. So I think my emphasis is how it influences behavior. And the examples we know, I mean, one of the reasons why we have a real estate bubble in most of the world is because Basel encourage banks to lend to real estate, because under Basel risk algorithm, banks kept less interest, so less capital, because there's a collateral. But that logic and that risk sort of calculation forgets that you can create bubbles and then you can change behavior that may have unintended consequences, as we have seen in 2007, because it's basically was a real estate lending business that caused the crisis. So I think that's, as I will talk in my recommendations, is involves how to use advocacy when these rules are developed, that the credit unions try to influence that the regulation reflects their own risk profile, rather than being imposed upon something that didn't even work for banks. And finally, I think that's more interesting, because there's this increasing support for fintech by regulators to make banks more competitive. Obviously, it influences all businesses, and then it is a reality that especially younger generations use their mobile phones to transfer money and to do certain banking transactions. I'm skeptical of the narrative about fintechs that they're going to revolutionize finance and they're going to take over the financial system. I think it's grossly exaggerated, but nevertheless, especially in payments, they do have some influence. And then we see even banks looking at how it might influence their business model. I mean, the most sort of interesting development there for me is banks in the UK and in the US in retail banking, their business model relied on opening a deposit account when younger people went to university. And then as they grew older, they started other products, credit cards, car loans, and then the mortgages. So the opening the deposit account was the key to selling those more expensive products. But what they realize now is the younger generation, they might be converted to buying other products through an electronic payment product. So if you're an electronic payment product, then you can sell other products in relation to that. So it is, but it's also creating issues, as I'm sure you are aware, that like Clara, buy now, pay later products, creating some increasing debt for people who are may not be able to pay back. But the electronic payments related mobile banking products seem to be changing behavior. So what could be the implications of those for the credit unions? That's really my point. So stick on the recommendations. I think there are intergenerational issues, which is a social trend. and it's happening in some countries more than others, like in the UK. Now, students graduating with £50,000 loan, and now it's going to be even longer to pay it back. So the sort of colloquial mom and dad bank thing becoming a reality. Then how can credit unions too can think about intergenerational deposit and credit products, because banks are thinking about that as well. And also increasingly the usage of e-commerce and the ease of using an electronic payment, then how does it influence the credit usage? I think that's, again, a product that the credit unions may want to look at. So how can you be present as a credit provider to your members when they buy things online? Because there's also a risk that they might go to someone else, to a fintech company or a bank. And also, we know that especially low-income people, loans are always expensive for them, and then shorter term, although interest rates are low, the size of the loan can be high, and then we know that increasingly people rely on credit. So that could be another way of looking at whether the membership needs those types of loans. And then finally, which I think is quite interesting, is now countries at the national level, but also cities at the local level are setting net zero targets. And some of these things will relate, like I was talking about the charging stations for electrical cars, but also converting to a greener home. And then we know that big banks increasingly closing their branches and then centralizing sort of the channels. And then especially with SMEs, they're losing that kind of relationship with their customers and SMEs. So I thought that would be an interesting way of increasing the loan volume, interest income, but this time working with national authorities or local authorities to create some interesting credit, and then maybe sharing that risks with that credit with the authorities, because they want to achieve certain targets. These even could be some companies, because now companies are increasingly announcing emission targets. So that's kind of the set of recommendations to increase interest income due to the changes in the environment. I mean, I'll not talk much about the Basel, the capital, but it is something I think credit unions, because talking to some regulators as well, especially in Ireland, I got the impression, and they kind of agreed with me, that credit unions tend to be reactive rather than proactive when these capital adequacy, risk-related things are introduced. So I think having an advocacy capability to follow these developments and explain the true risk profile of credit unions, where basically where you don't have shareholders, members are the owners, and then deposits are a different type of relationship with your members. So, and then also the lending decisions. It's basically people borrowing their own deposits. So alternative sort of risk methods in relation to the regulators' sort of concerns I think that requires an advocacy capability. And then finally, as I was talking about the fintech and digital finance, I mean, here, from my perspective, fintech startups get subsidy from the regulators. And this subsidy in the form of having free access to the data, the open banking regulation from banks. And also the sandbox facilities that central banks and regulators offer to fintech startups, but also to banks themselves, where you take your digital product and the regulator checks it for you, whether it complies with the data laws, regulations, and how it might work. So they create a lab. So I think the credit union movement can benefit from those services that the regulators provide, because they're not they're not sort of discriminate that. I mean, even Lloyds and HSBC, they take their products to be tested. So you don't need to incur high legal costs to find out whether you comply with the regulation, and also test with some customers whether it's going to work or not. And these don't tend to be, I mean, they don't need to. I mean, we talk about digital fintech, but it's not really nuclear science in terms of the use that they have. It is like, especially under COVID, there was a fintech company which allowed elderly people not to be, involved in a fraud when they receive a text message on the phone, so they can check whether it is a genuine text message from their bank or somebody's trying to, attack their accounts in the cyber world. So they don't need to be that complicated, but serves the needs of the customers. So I think these are, and also looking at whether credit unions can work together to create an infrastructure that will serve them all, and then look at the products that clients need. And increasingly, we know that the younger generations they use their mobile phone for money transfer and then small credit purchase. And here I can see some synergies, because the issue with the fintech startups, they don't know finance, they know technology, and they don't have deposits. Whereas the credit unions, they have deposits, they have the customer base. I mean, recently I sent my report to a couple of my colleagues. For example, in the US, I use the data from the your global credit union data provider. The penetration ratio is 56%. So 56% of the people who have over the age of 16 have a credit union. Or in Ireland, it is over 100%. And the total assets of credit unions in the US is $1.5 trillion. So collectively, we're talking about financial services institutions that they have significant sort of impact on financial services. Whereas a fintech company, just because the number of customers they have increases by 20% from 50 to 75, that market value increases. So I think there might be good ways of bringing the strengths of both sort of institutions together, and the like-minded, socially minded digital finance providers to create a digital channel for the credit union membership. Right, I'll stop that. But so basically, this is my report is about, and it will be good to hear from you whether these things make sense, and then But anyway, over to you.
Thanks, Ismail. So I suggest that I'm just going to remove the spotlight, and hopefully everyone can see everyone else. It's not working on my machine. See a gallery. I
mean, I can take this off if you wish.
Yeah, maybe that would be a good idea. And perhaps
we can.
People can show their faces as they're. Let's just see if people can put their hand up either digitally or physically if they've got a question for Ismail to start us off, or some responses or reflections on what he said. Roland is from Salford Credit Union. And just a reminder, everybody, you're muted. So if you could unmute yourselves to ask your question, great.
Yes, you mentioned government relationship with credit unions, and there is, of course, a huge vulnerability, I think, in community credit unions, in that a lot of its work is actually redistributing the grant money, what do they call it? The grants they get from government are paid on a regular basis, and their expenditure is not regular. And the universal credit in the UK, of course, and their expenditure is not regular, and so the credit unions step in and lend to them when they've gotten it, and then they use the universal credit to repay the borrowing. Now, this is potentially an extremely safe way of financing, and it's working with the government. The problem for the credit union is my guess would be that a lot of credit unions charge this particular loan product too much. The risk is very much lower than the interest rate that they're charging, and in a way of shortening the relationship with government is that they could turn around and say, well, we could run this, we could have it as a facility on universal credit, that you build up credits and you can go negative for a bit and positive. And so the thing about the credit union movement is that it is kind of free enterprise, and the government is kind of not free enterprise in this area. So in a sense, government involvement could easily turn into undermining the financial structure of the credit unions. I mean, the ethics of charging interest rates, particularly if you're charging different interest rates to different loan products, is that essentially you get the virtuous and the fortunate paying for the less fortunate and less virtuous. There's a kind of difficult moral equation going on here, and that I think is problematic. If anyone was to unpick a credit union on ethical grounds, which working with the government might well happen. So getting too close to government could be problematic for credit unions.
Ismail, do you want to respond on that?
I mean, the particular example you gave, Roland, Yeah, I mean, I can see. But I mean, for net zero loans, I think like most things is about understanding the need. I mean, of course, the interest rate is high. I mean, with payday loans, when we look at the sort of interest rate charge, it looks high because they have to show. But at the same time, I mean, I disagree with the sort of loan shark mentality. But at the same time, you're not just charging an interest rate; you're combining a service cost in your interest rates. So I think we need to look at. I don't know that particular product, but we know that servicing costs are usually high when you're dealing with small amounts, yeah, and an uncertain condition. So I think my suggestion would be to tell the government there's an interest rate element, which is the risk, as you say, is low, but then there's also the servicing cost. So I think it is to separate those two things. And I mean, I haven't looked at that particular product, but I bet there's that kind of element. And then banks tend to roll these things over. And I think for me, that was the issue with the payday loans as well. I mean, if they say, look, it takes you 30 days to get an overdraft or 2 months to get an overdraft facility, but I give you in 1 day because I have a superior sort of a digital risk management or risk assessment. Some of it is, I think, true. I mean, I think with payday loans, digital payday loans, they were driven by increasing the number of customers. But I think we need to be careful here. There is a cost. I think we should be separating those, which is because of the risk and which is because you incur costs or you provide a service that others do. I think with net zero loans, that's my sort of approach. And increasingly, like when I talk to some fintech companies, they say, look, if a small company, SME, wants to create an online payment system, it takes 3 months for a bank to provide that because banks are not interested in them. Or as we know, that they calculate cost in such a way that, you know, is they say, oh, I don't want to do business with you anyway because you're too costly. You're small scale. I need to have a branch to serve you. So I'd rather not do that. But a fintech company can create an electronic payment system for an SME in 3 days. And that's how they're capturing those. So I think we need to look at those and then see how much of it is because of risk, how much of it is because of covering the cost of servicing that sector. So I doubt government can do it at a lower cost than you do, or a bank, because they tend to charge all their overheads, which are higher than yours. But anyway, I would say we need to separate and then look at the risk element and the cost of servicing element.
Yes, I mean, I think in a way it's wrong to talk about credit unions as a group because accountant AGM just yesterday, the credit unions are very different. Well, they're very different because you're looking at the problem through the wrong window. What you should be looking at is not classification of not credit unions, but the type of loans. Because I mean, an employee type loan is far safer than say an unsecured loan to a man. I mean, we did actually do some analysis of the different types of risks we were facing, and women with families were much less risky than men for various social reasons, and then loans financed through government universal credit are much lower risk than say a student type loan, and these risks are hugely different. And as I say, that there's a kind of moral dilemma in the fact that the credit unions tend to overcharge one in order to finance, to keep the rates down on the other. So, I suppose you could argue that morally both ways, but I think, I agree with you about the government getting involved in the mechanics of it would be an utter disaster. But the different types of product really makes some credit unions look incredibly well up. They are incredibly well off, and other credit unions are just scraping by, and they're all under one roof, and one is being over provided for, and the other isn't. So it creates problems on all fronts, really. So on your point about fintech, we had just quickly point on the fintech. We had a few years ago this American company coming in. Well, Nick would probably know the name. Who are going to do a solution package, and they provided the fintech for American credit unions, and it proved to be an utter disaster. But the model that we and I think other credit unions follow is to have, as you were saying, small little bits that you get from here, there, and everywhere, and join them together. And then if one bit doesn't work, you can just substitute another bit, and they're all competing with each other. We're a bit better for this, that, and the other reason, and it works as a model, and it's very robust as well. It's kind of like a bit like the internet model is a very robust. It's this emerging concept in organizations that you don't sort of build from the top down, you build from the bottom up. What works in once, repeat until it builds up into a structure that is replaceable, and like the internet itself, very, very robust. So that's our
no, I agree. I don't know the specific example, but I agree. It's got to be a very cautious approach, because they tend to promise you the
absolutely
the world, and then they tend to talk about, but they don't understand finance. I mean, I go to these meetings with fintech. They have no understanding of finance. They know technology, but it's exaggerated. I think that's why it's got to be like you said, and I believe it's got to be small things, simple things. It doesn't need to be sort of revolutionizing the whole thing with expenditure. This is small technological solutions, and if they don't work, then they can be got rid of without much problem.
I'd be interested to know if from some of the Irish colleagues on the call, whether there are what the interaction with fintechs is like for Irish credit unions who many of whom got deeper pockets than the British credit unions and the opportunity to invest. Is there a live discussion in the way that Ismail has suggested? There's a bunch of people who know some stuff about tech and can do some things very quickly, but they don't really understand savings and loans or financial services. So is the credit union sector or individual credit unions, are they picking up that conversation with fintechs?
Nick, it's Alan here. I think we are individually and collectively at times, but one of the problems here is that in the main there's two providers. There's more, but I suppose covering 95+% of the credit unions. There's 2 providers of our core platform that we use. Okay, and they keep it pretty well locked down. So the ability to engage with fintech and interact is limited somewhat by that. We've tried to start looking at this other ways and approaching it different ways by using, say, RPA to go in the front door of the system rather than going in the back door. Because in an ideal scenario, what we have is a set of published APIs that would allow us to go and engage with these fintechs. So I think there is some good examples and of it, and I think Life Credit Union, I think, is in NACE is one that I know of that have kind of gone to a fintech and used that kind of specializes in a loan origination system and underwriting system. And there's another credit union in the west of Ireland that is using another company. Their name escapes me, but it's a kind of a decision as a service type model. So where we're like, our core platforms are pretty good at what they need to do and to be the main system of record. So where we need fintechs is to allow us to expand the range of services to members or digitize more in certain areas. But we're very much limited by the engagement. Now, one of the core providers is better than the other, but we're limited by the way they lock their systems down, more so than it would appear is the case in the UK.
Right. Yeah, I think it probably is actually. I think it's probably pretty similar in the UK, but there is some. The size of the credit unions means that they can actually be a bit more nimble in some ways. So this credit union Roland's involved with has done some quite interesting things, despite being an awful lot smaller than a lot of the Irish credit unions. But the core processor is, I think, pretty terrible actually. But it does, as you say, as an accounting system, it counts things up properly. It's just it's very inflexible on purpose. Yeah. So I don't know whether there's are there user groups with the core processor, customer user groups, who are able to put pressure on the core processors to open up the APIs, as you suggest, Alan?
Yeah, so I can only speak for our the system that we use, which is probably the larger one at this stage in terms of number of credit unions in Ireland, and it's something that because I'm involved with the user group, and it's something that we're trying to do, and we're trying to get better organised ourselves. One of the problems is the lack of standardization in a lot of the kind of core processes across credit unions. So when we've been looking at APIs and we've been talking to the provider about APIs, they say, okay, well, that'll work for you in Heritage, but it won't work for 5 other credit unions because they actually do this slightly differently and they handle this piece slightly differently. Another problem where we've only used RPA in a small way to do with kind of analysing and transactions from a money laundering point of view. But we can put a lot of time and effort into trying to get a fintech solution up and running. And I know this has happened for other people where they've got integrations and then there's a change in something on the database structure on the core processor that's unannounced or not pre-planned. And that results in a difference. So what we're trying to do at a user group level, and it's literally live at the moment, is to change the way we organize ourselves and to actually come with, I suppose, our demands in terms of the specifications of certain solutions that we'd like, and trying to collectively, I suppose, use that bargaining power of all the users and kind of stop the provider of the core processor kind of using a divide and conquer methodology, which is exactly what they do, and they're really good at it. They're really good at relationship management at an individual level in credit unions. So what we're trying to do is organize ourselves a bit better and kind of give ourselves a charter that says this is what we're about, and these are the kind of the key areas that we need to get tech solutions in, and we are your users and we demand that you allow us to do X, Y, or Z. But that will involve a certain amount of, I suppose, giving up of a certain amount of autonomy from the part of individual credit unions, because we've got to get a degree of standardization in these areas in order. So the conversations that we've had with fintechs is that they if they're going to provide a solution to 20, 30, 40 credit unions, that needs to be relatively standardized across those credit unions. And that might be a bigger challenge than getting the provider of our core system to engage. Actually getting 40 credit unions to standardize something might be a bigger challenge.
Yeah, there's a herding cats problem there, isn't there? Definitely. Yeah. Thanks, Alan. So we some really interesting contributions there from Roland on product and Alan on systems. And I wonder, just as we we're coming towards the end now, if there's any comments on the policy side of Ismail's analysis. For example, interest rates or capital. So from one of the things I thought was interesting is I was reading the drafts of Ismail's paper as they were coming through. It was exactly at the time when in Britain there was an increasing discussion about the need for the central bank to raise interest rates in order to deal with inflation. And I don't want to get us to get bogged down in economics here, but there's the practical implication of whether or not interest rates go up is quite profound, particularly for Irish credit unions who at the moment are having to cope with negative interest rates on part of their deposits. So I'd like to ask Ismail, but I'm keen to hear from other people as well, whether or not Ismail sees his somewhat gloomy forecast about low base rates being locked in for the medium and even potentially the long term, whether he would revise that in light of current events. I don't know whether anyone else has got anything to add on the interest rates or capital before Ismail responds on that.
Well, I'll just share my screen because I had a couple of. These are in the report. Yes, there is inflation and interest rates are increased, and then US as well. I think US is very important. If US increases, then the rest will. But UK started. But how much? I think that's my point. Now, this is central bank rates since year 2000. So my analysis is we are not going to go back to 4 or 5% policy rates. So I think we will see basis point increases, like 25 basis points. I don't anticipate in the near future full percentage increases in an incremental way. Now, first, I don't think the general approach is this inflation is transitionary because of COVID, supply chains, etc. But of course, the world throws at us interesting risks. Who could have anticipated invasion of Ukraine and the impact on energy prices? So that will generate a new dynamic. But central banks have been pivotal in keeping interest rates low. And the reason why I think the rates will not go back to 4 or 5% policy, because we have too much debt. This is especially after COVID, governments have too much debt, households have too much debt, and the way central banks have dealt with it, I think this is the IMF's calculation. Debt levels have increased, the blue bars, but the interest expense by governments has declined. So I don't think the governments in the UK, US can afford to pay a high cost because they're not having tax income. So I think the driver of the interest rates will be the high levels of default on the household sector, especially mortgage loans, and also governments. Increasingly, they need to spend more because the economy is not growing, and they will be in trouble. So I think we will see sort of basis point increases, and that's my reading based on that. But I don't know if we're going to see like full 1% increase in the near future. I think They're also doing these basis point increases to send a message that, I'm tough with inflation, rather than really wanting to increase interest rates. Otherwise, we have governments having serious problems, banks having serious problems, especially with the repayment of mortgages.
So do you think that negative interest rates are going to be sustained in the Eurozone? I'm particularly thinking of Irish colleagues who are, as I say, paying negative rates on some of their deposits. Do you think that might, that over time that might get eliminated, or is that here to stay as well?
Again, economics is, I don't want to go down it. It's very difficult to predict. Negative interest rates, I think we have the short term, medium term, and long term. I think in the short term, with the inflationary pressures, they are less likely to stay at negative terrain. But in the longer term, I wouldn't rule it out. Or I would say zero interest rates, because Europe has resisted, ECB has resisted to increasing interest rates, because the inflationary pressures in Europe is different than the UK and the US. So there's less, there's a higher reluctance by ECB to increase the interest rate. So I would say negative interest rates or zero rates are more likely to be the reality in Europe. That would be my sort of view before the Ukraine invasion by Russia. But I think it will have two pressures. Yeah, they don't want Italian banks to go bust, because Italian banks are really in trouble, and any increase in interest rates will increase, especially in countries like Italy, default rates, and economy is not growing very well, and then sovereign debt is still problematic in countries like Greece and Spain and Italy. So I think the general tendency will be to keep the interest rates at that zero level, but not going too much into negative territory. That's a European case, I think, which is a bit different than the UK and US case.
Well, that's I guess that's a potentially slightly gloomy note to end on from a credit union perspective, but I think it brings the focus back to those recommendations you made, and which I know that colleagues in both Ireland and the Group GB are wrestling with, which is lending, how to find new ways of meeting member borrowing requirements that are economic, because can't rely on any effective separate income streams from liabilities now.
Especially I think net zero, I would say, look at it seriously, and then look at, local authorities as well. They now committed themselves to meet certain targets, and I doubt big banks would be interested in making those small loans to, for example, do electricity sort of charging station on streets or communities.
Well, I'll say this informally because this is a small audience, but it is our sort of working plan for the moment for our conference in May, to focus on the 20th of May, the Swoboda conference, which will be in Dublin, to focus that around green lending and opportunities for credit unions around that. We haven't kind of got the details nailed in about some of that, so I'm not putting anything in writing, but that's absolutely an area we're keen to focus on and help with. We've reached 11:30, and we did say we'd finish. So just want to say thank you to everybody for participating. If you've got questions for Ismail that we didn't get to discuss, then I can put you in touch with him directly, or I'm very happy to, if you contact me, to act as a sort of go-between. we'll try and find other opportunities to pick Ismail's brain in the future and give our members a chance to talk to him. He's got a lot of interesting things to say to us, I think. And there's a lot of food for thought in his paper. So many thanks again for participating. Do let me know any thoughts on the session, and we'll hopefully see you all again at a conference or webinar soon. Thank you.